Hello everyone, welcome to Talk Talk Speak. Today, well, let's just jump right in with this incredible number. Imagine putting $10,000 into Berkshire Hathaway back in 1965.
Okay.
By 2025, that would be worth roughly $355 million.
Wow. $355 million. That really says it all, doesn't it, about Warren Buffett's success?
It really does.
Okay.
And it makes you realize this isn't just about, a few lucky stock picks. That kind of growth, it points to something much more fundamental.
Exactly. Something systematic. And that's what we're digging into today, right?
Absolutely. This is our deep dive into, well, the legend, the investment journey of the Oracle of Omaha and Berkshire Hathaway. We want to go beyond the sort of surface level stuff, the simple tips, and really uncover the underlying principles, the strategies, sometimes surprising ones, that powered this unbelievable growth.
And we're grounding this discussion in some solid analysis. We're using insights from a report called Oceanary. It's a pretty detailed look at his key investment moves.
Yeah, and think of this as maybe a shortcut for you. We're trying to distill the core wisdom, pull out the most important bits, the surprising facts, without drowning you in data. We're aiming for those aha moments. Yeah.
And the scale of what they've achieved. I mean, the numbers are mind-boggling, but it's the how. That's where the real lessons are for you, the listener.
Exactly. Which brings us to the big question, really. How did this struggling textile mill, a company that looked like it was finished, how did it become this trillion-dollar giant? And more importantly for you listening, what can you take away from these strategies? They seem simple sometimes, but they're incredibly effective. Let's get into it.
Yeah, let's do that. And maybe hitting those big numbers again helps frame it. So by 2025, market cap over $1.1 trillion. The compound annual growth rate, the CAGR, from 65 to 2025, almost 20%, 19.9%. Compare that to the S&P 500 over the same time, about 10.35%.
Big difference.
Huge. And the total return, this number is just staggering. 3,787,464% versus the S&P's 36,974%. I mean, the report calls him the stock god, and you can see why.
Stock god. I like that. But as the report we're looking at points out, and this is key, his success isn't just about picking stocks. It's tied up with Berkshire's structure, right? Just with the insurance side. The float.
Absolutely crucial. The float. It's basically the money insurance companies hold the premiums they collect before they have to pay out claims. Buffett, very astutely, uses this float. Think of it like a massive near-interest-free loan, often long-term.
Yeah.
He uses it to fuel Berkshire's investment.
Gives them incredible firepower and patience too, right? Especially when markets get choppy.
Exactly. Patience is key. And it's a structural advantage. It's really, really hard for other investors to copy that.
That makes sense. It gives them this stability, this capital source others just don't have.
It does. So the report's mission, our mission today, is to look at 10 specific milestone investments. These really show the business logic, the investment art, as they put it, behind the legend. These weren't just random wins.
And they picked these 10 for specific reasons, didn't they? It wasn't arbitrary.
No, not at all. The criteria were things like how representative they are of his overall strategy, the impact they had on Berkshire, how unique the move was at the time, and importantly, what we can learn from them, the teaching value.
Okay.
And just so you know where we're going, the 10 are National Indemnity sees Candies, The Washington Post, GEICO, Coca-Cola, American Express, Capital Cities ABC, Salomon Brothers, Apple, and the Japanese trading houses.
That's quite a list, a real tour through business history. Yeah. And looking at Table 1 in our source material, the long-term performance numbers, they just set the scene perfectly. Berkshire's A-shares, the book value growth, consistently beating the S&P 500 since Buffett took over.
Yeah, the book value AGR really jumps out. From 1965 to 2023, it's 19.8%. That's nearly double the S&P 500's 10.2% over that same stretch. I mean, sustained outperformance like that for that long. It's truly something else.
And for anyone wondering, your AGR, compound annual growth rate, it just shows the average yearly growth, assuming you reinvested the profits.
Right.
Smooths out the bumps.
But Buffett's approach, it wasn't always the same, was it? It changed. The report talks about a shift away from Benjamin Graham's cigar-butt thing towards Charlie Munger's influence.
Yes, that's a really critical evolution. Early Buffett was very Graham. Buy super cheap companies, even if they weren't great businesses. The cigar-butt, find one with a final puff left in it for free.
Right.
But Charlie Munger really pushed him towards thinking about quality, buying wonderful companies, businesses with real, lasting competitive advantages, even if you had to pay a fair price. not a rock bottom one.
And that Munger quote captures it perfectly. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Seems simple, but it's a huge shift in mindset.
It really is. And See's Candies, which they bought in '72, is often cited as the turning point, the classic example.
That's where Buffett really saw firsthand the power of a strong brand, how it gives you pricing power, consistent profits. It kind of moved him beyond just looking at the numbers on a balance sheet. He started appreciating intangible value.
So CEOs helped cement these core principles, like the idea of economic moats. Can you break that down?
Sure, an economic moat. It's like a protective barrier around a company's profits. A sustainable competitive advantage that stops competitors from easily eating into their business. Buffett loves businesses with wide, deep moats.
Like a castle moat?
Exactly.
Yeah.
Filled with, metaphorical alligators. Keeps the competition out. These moats can be things like super strong brands, think Coke or Amex, or network effects where a service gets better as more people use it, high switching costs, maybe it's just a pain for customers to leave, cost advantages like GEICO's model, or even regulatory hurdles like licenses.
So it's about finding companies that have this built-in protection, this edge that's hard to copy, so they can keep making good money.
Precisely. Keep those profits safe long term. Then, another huge principle, exceptional management. Buffett is famously picky about who runs the companies. He looks for ability, obviously, especially how good they are at allocating capital. But just as important, maybe even more so, is integrity and whether they truly put shareholders first.
Yeah, there's that quote in the report. I can understand losing money. I can't understand losing reputation. That says a lot about the culture he built.
It really does. Integrity is paramount at Berkshire. The investment in Capital Cities ABC, for example, is often highlighted as Buffett basically betting on the manager, Tom Murphy, who he admired immensely.
Okay, and then there's the circle of competence. Seems basic, but crucial.
It is. Stick to what you know. Buffett always emphasizes investing only in businesses and industries you genuinely understand. You don't need to know everything, but you do need to know the boundaries of your knowledge. If something's outside your circle, just pass. Doesn't matter how good it looks.
Makes total sense. Avoid things you don't grasp. And finally, margin of safety. Back to his roots with Graham.
Yes, this is fundamental. Buy a company for significantly less than its intrinsic value, what it's actually worth. That gap is your margin of safety.
Your buffer.
Exactly. It protects you if your analysis is a bit off or if unexpected bad things happen. And, of course, it boosts your potential return when the market price eventually catches up to the real value. Like Buffett says, price is what you pay, value is what you get.
Okay, so those are the core ideas, the philosophy. But let's circle back to Berkshire's engine room, that magic of insurance float. Can you explain that a bit more?
Sure. So again, insurance float is the money insurers hold between collecting premiums and paying claims. For Berkshire, with its huge insurance operations, this pool is massive. By the end of 2023, we're talking about roughly $167.8 billion.
Just an incredible sum. And the magic is that it's cheap money, right? Or even better than cheap.
That's the key. If the insurance business itself is run profitably, meaning underwriting profit, where premiums taken in are more than claims and costs paid out, then this float costs close to zero, or it can even have a negative cost.
Meaning they get paid to hold the money.
Effectively, yes. So Berkshire has access to this enormous, stable, long-term pile of capital that's either free or actually generates a small profit just by existing. It's an almost unbelievable advantage for investing.
And that advantage must massively impact their investment strategy.
Oh, absolutely. 3 main ways. First, it's long-term stable capital. Unlike, say, a mutual fund manager who might have to sell good stocks if investors pull out their money, Buffett doesn't have that pressure. He can be patient.
Okay.
Second, it provides immense purchasing power. They can make huge bets, buy whole companies even when markets are tanking and everyone else is scared or forced to sell.
Right. Buying when there's blood in the streets.
Kind of. And third, by taking this very low-cost float and investing it in assets that generate higher return stocks, businesses, they significantly amplify Berkshire's overall investment results. It's leverage, but very smart, low-risk leverage if the underwriting is good.
But that if is important. It's not automatic. The report stresses underwriting discipline.
Critically important. The whole float advantage disappears if the insurance businesses lose money on the actual insurance they write. If they just chase premiums, cut prices too much, take on bad risks, Well, then the float isn't free anymore. It's expensive.
Right.
So companies within Berkshire, like GEICO and National Indemnity, have historically been very focused on underwriting profitability, making sure they price risk correctly. That ensures the float is high-quality, low-cost fuel.
Okay, foundation laid, philosophy principles, the float engine. Now let's get into those 10 key investments the report analyzes. Starting right at the beginning. National Indemnity, 1967, called the cornerstone.
It really was a pivotal moment, acquiring National Indemnity in '67. This wasn't just their first big insurance move. It was Buffett putting his understanding of float into action. It fundamentally shaped what Berkshire became.
So set the scene. 1967, Berkshire still mainly a textile company, right?
Right.
And float probably wasn't a widely understood concept.
Exactly. Berkshire was just starting its transformation. National Indemnity, based right there in Omaha, was this well-run kind of niche insurer. They covered unusual risks, taxis, trucks, even circuses, and crucially, they had a track record of profitable underwriting.
Okay.
Buffett bought it, along with the sister company, for $8.6 million. Now, that was a bit over its book value, which was around $6.7 million. But, and this is key, it gave Berkshire control over more than $19 million in insurance reserves. That was the float.
So he saw that $19 million float, knew National Indemnity was profitable at its core insurance business, and realized he could invest that float much more effectively.
Precisely. He understood that profitable underwriting meant that float was essentially free money to invest elsewhere, and he liked the way National Indemnity operated. The founder, Jack Ringwalt, had this philosophy. There's no such thing as a bad risk, only a bad rate.
Interesting.
It showed discipline, a focus on profit, not just volume. That really clicked with Buffett. It showed his foresight leveraging this profitable float was the game changer.
And $8.6 million back then. That was a significant move for Berkshire, right? Getting them properly into insurance and giving them control over, what, a $30 million plus investment portfolio.
It was a major step. And the long-term impact, just immense. National Indemnity became the bedrock of Berkshire's insurance operations. It was central to growing that float from, tens of millions back then to that huge $167.8 billion figure by late 2023.
And that float then funded all those other famous investments.
Right. Coca-Cola, Gillette, Amex, Apple. Much of that was powered by the growing insurance float, which started significantly with National Indemnity. Plus, Buffett's skill in investing that float generated massive returns, amplifying everything. And don't forget, National Indemnity itself often made money on the insurance side underwriting profits.
So the float wasn't just free, it was sometimes better than free.
Exactly. The report notes periods, like in the 80s and 90s, where they had consistent underwriting profits. That means the float had a negative cost. They were literally being paid to hold and invest billions of dollars.
Incredible. So why does the report label this acquisition surprising, beyond the great financial outcome?
Well, a few reasons. First, it really did lay the foundation for Berkshire's entire future business model, this diversified holding company fueled by insurance. Second, it showed Buffett wasn't just a stock picker, he was building a capital allocation machine. And third, back then, thinking of an insurance company primarily as a source of cheap investment capital, that was quite contrarian, not how most people viewed insurers.
Got it. And what are the big takeaways, the investment wisdom from this specific deal?
Several key lessons jump out. First, understand the real essence of a business, including unconventional value sources like float. Second, look for cash cows, businesses that throw off cash without needing huge reinvestment. Third, for insurers, underwriting discipline is everything. It ensures the float is cheap and reliable. Ringwalt's bad rate philosophy highlights that moat risk control. And finally, build structural advantages. Don't just make good investments, build systems that amplify your edge.
The report's summary table for National Indemnity probably pulls all that together nicely.
Yeah, it lays out the timing, target, amount, the core logic, the insights, the long-term contribution, and those surprising elements we discussed. It's a good snapshot.
Okay, so recapping the key points from this first deep dive example. The sheer power of insurance float, when managed well, is undeniable. And we see Buffett very early on thinking differently, not just stocks, but building this incredible business structure.
And it's amazing how that single, relatively modest acquisition in '67 set the stage for decades of compounding growth. It really highlights the power of getting the underlying business economics right.
Which definitely makes you think, for you listening. Are there overlooked float-like advantages hidden in plain sight in businesses you see every day? Or maybe thinking about underwriting discipline that focus on core profitability and risk management? How could that apply to things you do, personally or professionally, for more sustainable results?
Yeah, it's a good question. How do we spot those less obvious structural advantages that create lasting value rather than just focusing on the surface level stuff?
Definitely something to consider. What industries today might have some unsexy, overlooked aspect that could be the key to long-term value, kind of like float was for Buffett back then? So what does this all mean for you? That's something to ponder. And speaking of pondering, thank you for joining us. See you next time.